Why do most traders buy at the exact peak and then panic sell at the absolute bottom? Millions of people enter the market every day convinced they found a flawless indicator or a foolproof strategy, yet most end up losing money. They have the technical knowledge to read a chart, but they lack the self-control to ignore their own impulses. Today, we are uncovering the hidden profit game being played between market highs and lows. We will look at how smart money exploits fear and explore a perspective from trading psychologist Mark Douglas that redefines how you look at the screen in front of you. Traders hemorrhage money because they misunderstand the psychological environment they've entered. They are stepping into a system that rewards discipline and punishes human nature. Look at this chart tracking an aggressive rally. The asset pumps and fear of missing out takes hold. You buy at the peak. Then the market dips. The bounce never comes, so you panic sell at the bottom. Almost immediately, the market reverses. This cycle is a structural feature of the market. It is built to extract wealth from human emotion and hand it to those who can remain detached. Mark Douglas viewed the market as a neutral environment. To him, the price action on this floor was simply a mirror reflecting the collective fear, greed, euphoria, and panic of the participants. This perspective reveals the central conflict of trading. You are never battling the market or the institutions. You are strictly battling your own psychology. In this hidden profit game, wealth moves through emotional reactions. The market identifies where the crowd is most vulnerable and rewards those who take the opposite side. When prices reach a high, retail traders become aggressive buyers, fueled by greed. This surge in volume provides the exit liquidity that professionals need to sell their positions at a premium. When the market crashes, those same retail traders dump their assets in a state of panic. Professionals step in to buy. That fear, picking up discounted assets from people who can no longer handle the stress. The market feels rigged because professional traders have learned to monetize the predictable emotional instability of the amateur crowd. Major historical crashes provide a macro view of this wealth transfer. During the dot-com bust from 2000 through 2002, the cycle played out across the entire economy. At the top, the public believed prices would rise forever. By the time this floor was covered in discarded sell orders, that euphoria had turned into apocalyptic despair. Both extremes created massive opportunities for those who remained calm. Most retail traders fail because they fall victim to specific emotional traps. They overreact to small moves, they try to revenge trade after a loss, and they refuse to accept when a position has gone against them. Beginners spend years searching for a strategy that offers perfect certainty. Professionals accept that certainty is impossible and focus their entire effort on risk management and consistency. Douglas taught that elite traders must change how they process a loss. He offered a perspective that allows a trader to lose money on a single trade without losing their emotional composure. Demanding certainty in an environment governed by human emotion is a flaw that leads directly to financial ruin. This distribution shows how a series of individual losses can still result in a profitable trend. Elite traders succeed because they think entirely in terms of probabilities. Once you accept that even a perfect setup can fail, your ego detaches from the outcome of a single trade. A loss is no longer a personal failure. It is simply a statistical cost of doing business. Amateurs feel a desperate need to be right on every individual trade. Professionals focus on managing their risk over a sequence of 100 trades, knowing the math will eventually work in their favor. Social media makes this detachment difficult. It promotes a culture of overnight wealth and emotional gambling, pulling traders away from the disciplined approach required for long-term success. Adopting a probabilistic mindset neutralizes the fear of being wrong. It allows you to execute your strategy with the same calmness whether the last trade was a win or a loss. Real professional trading is often surprisingly boring. It is a process of patient waiting, rigid risk control, and accumulating small, consistent wins over time. The market's ultimate test is a test of character. It asks if you can maintain your discipline while everyone else is losing their composure. Mark Douglas observed that the best traders have evolved to a point where they accept without any internal conflict that anything can happen at any moment. The next time the market moves violently, pay attention to your own pulse. Ask yourself if you are reacting like the crowd, or if you are thinking like the professionals who are waiting to take the other side of your emotions. Subscribe to Streets for more insights into market psychology and financial history. And tell us in the comments, which is harder to control in the heat of a trade, fear or greed? Long-term financial freedom begins with your own mindset. You must master your internal world before you can ever hope to master the charts.